Audits of inventory can be really tricky. Remember that our requirements say the balance sheet is inventory at the date of the end of the financial year. So what if we can't get around to all of our audit clients to observe and count inventory on the end of the financial year? Well, today in this video, I'm going to talk about timing, the importance of timing, and what we need to do when we can't quite get there to audit our clients on the very last day of the financial year. So let's get into it. Hi, and welcome back to all of my regular subscribers. To anyone who's new, hi, my name is Amanda. I do love to audit, and I teach audit to undergrads at a major Australian university. Now, today we're talking about inventory. Now, I know I've talked about inventory in other videos before, and I've talked about substantive processes for firms that purchase their inventory. But today I want to talk about timing. And timing is really important because our role is to check that inventory exists, we have the rights to it, it's complete and it's accurately valued as at the balance date, the last date of the financial year. And sometimes we just can't get around to audit all of our clients on that very last day. So today I'm going to dive into those timing complexities and how we can use two techniques, the roll back and the roll forward, to help us in those situations. So I'm going to switch over to my other screen behind my green screen and jump into my tablet right now. So we know that when auditing inventory, it's really important that we try and gather information about the balance at the end of the financial year. Okay, and that financial year in Australia is the 30th of June. It could be any date that the entity sets. So there can be some issues in regards to gathering evidence about the existence, completeness, valuation, rights and obligations, presentation and disclosure of inventory at that balance date. So what sort of things can come up? Well, the end of the financial year might be on a Sunday, or it might be on a weekend. So the factory or the business might not be open on that day to be able to calculate and observe a stock take of inventory. They might want to try and put this into everybody's regular work day rather than try and, squeeze it in on a weekend. So that's the first one. It could be something on a weekend. The other reason why we might have some timing differences, why we might not be able to gather that evidence right on the end of the financial year, is that there might be lots of different locations that the auditor has to visit, or that the internal audit team or that the stock take team have to visit. So if you've got multiple locations, that can be a little bit tricky. The other thing is also timing of annual results. So, we are doing our audit, but the client also has a whole lot of other stuff that generally needs to be done at the end of the financial year. So worrying about stock take right on the very last day might be something that just doesn't fit in with their scheduling and their timing when it comes to preparing the annual results. So what exactly are the solutions if I cannot do my stock take exactly at the end of the financial year? Well, if I can't do my stock take at the end of the financial year, I've got a couple of different options. Option one is that I could do it before the end of the financial year. Option two is that I could do it after the end of the financial year. Now, that means we're going to gather evidence about the existence, valuation, completeness of inventory either before the end of the financial year or after. So let me just draw up a little timeline here. All right. So we've got some different points here. So the middle one is my end of financial year. My one is my stock take after. And the other one is a stock take before the end of the financial year. So ideally, although I want it at the end of the financial year, if that's not possible, I can go before or I can go after. And then we have to do a different type of procedure in addition to counting, observing inventory either before or after. And those things are going to be called rollbacks or roll forwards. All right. So if I calculate inventory and I gather evidence on inventory before the end of the financial year, I'm going to need to then take this information. I don't know what's going on with my pen there. Let me try and fix that. And roll forward. So I'm going to need to take the evidence that I got here and I'm going to need to adjust it to be able to gather the balance that I need for the end of the financial year. Now, what happens if I do my stock take after? Then I'm going to need to take this information and I'm going to need to roll it back. Evidence from after the financial year gets adjusted backwards. Now, in terms of this roll forward and roll back, what am I going to need to do? Or how am I going to actually make this process work? Well, when it comes to rolling forward or rolling back, I obviously have my evidence at that date, before the end of the financial year or after the end of the financial year, and then I'm going to need to adjust. So I'm going to adjust the evidence and figures I've confirmed. Now, how exactly am I supposed to make those types of adjustments? What information am I going to have? Well, I'm going to have definite information on existence, completeness of inventory before or after. So I'm going to adjust this information with data that might potentially come from, let me just delete that, data might come from information about sales. Okay, because remember, when I make a sale transaction, I have debit, cash, or accounts receivable, and I have credit, sales revenue, but the other transaction that comes in here, debit, cost of goods sold, credit, finished goods inventory. All right, now because I have this, and I will be gathering evidence, so I will be testing this information about sales after the end of the financial period. So then if I can prove that the sales really did happen, I can use those inventory movements to either roll forward, so add it, or essentially subtract the inventory from there. Or if I've done my stock take after the end of the year, I can take those sales and I can subtract that from the inventory to get the inventory from the end of the financial year. So the roll back and the roll forward is really commonly used because we have lots of clients. We can't get to all of them on the last day of the financial year for a stock take. Now, there are some intricacies, I guess, or things to be aware of. I guess we should call them caveats. So beware here as auditors. There are some things to be wary of. So I'm going to write, oops. All right. So when can I use this roll forward and roll back type of situation? I can use it. I want to try and do my inventory count close to the end of the financial year. You don't want to do it too far away. There is no point in doing for a 30 June year end, calculating and observing inventory in January and then rolling forward 6 months. So you want to try and do it close to the end of the financial year. Now, there are no hard and fast rules here, but you want to try and do it in that 1 to 2 months before or after the end of the financial year. Definitely within that 1 month, even better if you can get it within a couple of weeks. So you want to do that inventory count close to the end of the financial year. The other thing that we need to be wary of is the quality of the internal controls. Okay, because if you're going back and you're relying on this sales and accounts receivable data and this other inventory transaction, then we can only do the roll forward and the roll back where we have good internal controls. All right, if we have weak internal controls, then the data we're going to be using for the roll forward or the roll back might not be reliable, and therefore there is increased risk. Where you have very high control risk over inventory, you want to try and do that count, stock take as close as possible to the end of the financial year. All right, the better the controls, the more you can do that roll forward and roll backward mechanism. Now, of course, you still have to do all the same things. You want to talk to management about their process for the stock take. Are you observing as the auditor? Are you counting it yourself because it's such high risk? Are you doing test counts? Are you not only checking from the stock listing back to the items, but from the items to the stock listing as well to make sure that you're testing existence and completeness. And we're going to get into testing valuation a little bit. I've already covered that in my video about auditing inventory, and I'll also cover it in future when it comes to manufacturing. Now, this roll forward and roll back, you might have a slightly different name at whatever audit firm you're using, but this is a completely acceptable way to gather evidence on inventory when we can't be there on the very end of the financial year. So if you've used a roll forward or a roll back, I'd love to hear your experiences in the comments. You can share those and help our students who are learning to become auditors really beef up their knowledge and help them tackle their professional qualifications, their university exams, and their practice out there on audit teams. Of course, if you have another great way to manage this process where we're not auditing inventory on the very last day of the financial year, I'd love to hear about it in the comments, help grow our community. So make sure that you're subscribed. If you haven't already, I'd love to see a thumbs up on the video. Drop me a comment as to where you're watching from. I love to find out where my viewers are. Stay safe, stay well, and I'll see you next time.